All right, chapter 16. In this chapter, we are looking at investments that corporations make in other corporations. So, the accounting for investments. On April 15th, Judy Company buys 1,200 shares of stock in another company named Bilbo and buys those shares for $15,000. On October 31st, Judy then sells 500 shares of that Bilbo stock investment for $7,500. We are going to prepare the journal entries for the purchase and sale of that investment or part of the investment. On April 15th, when Judy Company buys 1,200 shares of the stock for $15,000, they record it as an asset investment. So on April 15th, they would debit stock investments and credit cash. Essentially, what that does is record the investment at the price paid or the cost of the investment. On October 31st, Judy sells a portion of that investment. Judy only sold 500 of the 1,200 shares, or 500 divided by 1,200, or roughly 42% of that investment. That means that when we decrease the asset for being sold, we don't take the entire $15,000 out, we only take the portion that was sold. So of the total investment of $15,000, we will multiply it by the fraction of the investment that was sold. 500 divided by 1,200 times the 15,000 means of the total $15,000 investment, only the cost of $6,250 was sold. So we only decrease the investments by the portion of the cost that was sold. We debit cash for the amount of cash received on that sale, and the amount that it was sold for exceeded its original cost. So we have a gain on the sale of that investment of $1,250. Remember, gains are just like revenues. They cause our net income to increase. In this next exercise, we are working with the purchase of an investment for which the company can exert significant influence. When a company purchases stock of another company that exceeds 20% but is below 50%, it is assumed that the purchasing company can start to exert some significant influence over the portion of the company that it bought. So here on January 1st, Texas Company purchased 25% of Plano Company for $100,000. So because more than 20%, less than 50% of the Plano Company's ownership was purchased by Texas, it is assumed that Texas can exert some significant influence over Plano Company's operations. Okay, it doesn't have control because to gain control, Texas would have had to purchase 50% or more of Plano Company's stock. But they only purchased a quarter of it. So it's just considered significant influence. For 2014, Plano reported net income of $198,100 and declares a dividend of $60,500 in cash. So the first thing we need to do when Texas purchases that stock of Plano Company, we are going to be recording a asset. We will debit the stock investments, $100,000, and credit cash. What we have done is recorded the purchase of the investment. Okay. Now, at the end of that year, we are going to record the changes to the stock investments as a result of the Plano net income and the Plano dividends. When a company exerts significant influence, we end up needing to increase the stock investment by the portion of the investee's net income for the year. Okay, because Plano reported $198,100 worth of income for the year, 25% of that income of $49,525 will increase the value of the stock investment to Texas Company. So Texas Company will increase stock investments by the amount of their share of the investee's income and record it as a revenue from the stock investment. Okay, so essentially it's increasing Texas Company's income, its share of the portion of Plano's net income. Okay, and then for the dividends, a total of $60,500 in dividends was declared and paid by Plano Company. Of the $60,500, 25% of those dividends will go to Texas Company. So Texas Company will debit their cash for $15,125, and it will decrease its stock investment by the amount of those dividends received. Really what we're seeing here is the original purchase of 25% of Plano Company is really saying that 25% of the company is worth $100,000. And then as the company earned revenue, the value of that investment went up by the 25% or portion of the income. And then when some of that income was then paid out of the investee, it ended up decreasing the value of that investment to Texas Company. Okay, and that's essentially what we're doing, is we're trying to ensure that we keep track of the value of their 25% interest in Plano Company. And that interest increases as revenues are earned, but then as some of those revenues are paid out in dividends, it decreases the value of the stock investment. Even though Texas Company did receive cash, they did lose a little bit of value in their stock investment for the amount of the dividend. Okay. And what ends up happening here is we started the year, or started after the purchase of that investment with a investment value of $100,000. It was increased by $49,525, but it was then decreased by $15,125, leaving its investment balance at the end of the year in Texas Company's assets of $134,400.